Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are modeling out the impact of the coronavirus as we look to get back to work. Phil, thanks for joining me as always. And markets yesterday rallied on positive news of a potential treatment. I'm still trying to wrap my head around how we're nearly back to where we were trading before everyone went to work from home due to COVID-19. Earnings haven't been that spectacular. Guidance is not that clear, but yet here we are.
Yeah, I think a lot of economists and a lot of market strategists are thinking the same thing. The valuations that you're seeing, if you're looking at forward earnings and ratios, are at extreme levels, higher than they have been for most of the last decade. The news yesterday that really made the market rally was the remdesivir drug was showing some promise in its US studies, although it didn't show any promise in Chinese studies. So, that's the sorts of things that are driving the market now. At least it's not the news on new cases so much anymore. We're starting to look forward to vaccines and treatments and seeing the earnings come through. Not all the companies are having bad earnings. There's some good spots. There's not as much spending reductions in some sectors as we thought we would see. So the market's generally pretty positive just on the fact that things aren't as bad as we thought that they could be. I think the other thing that's worth remembering is we've got $2 trillion worth of stimulus coming through the system as well. So there's probably a lot of people with, thinking that the stimulus itself is enough of a stopgap that it'll make up for the GDP losses that we're starting to see.
All right, let's take a look at our first chart of the day with daily new cases. Not exactly under control, but not exactly back to peak levels, as you had mentioned.
That's true. And this is global data. The US data looks very similar. So at least we look like as a world, we've got the cases under control. All of the lockdowns that we've done have started to work. So the hospital systems are mostly under control. It's bought us a bit of time to get drugs like remdesivir into a test phase. There's a couple of other drugs that are showing promise as well. And that brings us closer to having something like a vaccine, or at least a way of treating people so that we'll have less mortality. And then hopefully, if we've got a way to treat people relatively successfully and the death rates go down, this might end up looking a little bit more like a common flu where you catch it, you might go to hospital, take some medicine for a couple of days, but you come out and you're still okay.
All right, let's take a look at GDP, which came out yesterday, negative 4.8%. Following quarter doesn't look to be much better. And that goes back to my question again. I feel like, for the markets to be so close to all-time highs, or at least, with the trajectory that it's been on, with spending not projected to do well, that's kind of where the question is.
Yeah, actually, the following quarter is expected to do way worse. I mean, think about Q1. For most of the world, we didn't start to lock down until the last 2 weeks of quarter one. Mid-March was when we started to all stay home. So really, this down 5% print is mostly normal market and just 2 weeks, maybe 3 weeks worth of a downturn. So there's some people with forecasts saying Q2 could be down 40%, which would be, again, off the charts. I think by the time we see that, we'll be so used to seeing data points that are off the charts, it might not scare us so much. The new claims that came through this week were still way off the charts from normal at 3-point-something million. We've got 30 odd million in total that have claimed new claims in the last 4 or 5 weeks. At least that's starting to slow down as well. But this is just an unusual event. It's a lot of people being forced to stay home and not work. And that's why the markets are starting to look forward and they're trying to work out, is it a 2 month slowdown, or is it going to be a 12-month slowdown? And that's going to make a difference to markets as we start to see recoveries and how people get back to work. What's interesting looking at the GDP data obviously services was hit because a lot of the services industry were the parts of the industries that were told to go home and not work for a bit. But healthcare services actually were down, and that impacted the GDP quite a lot. And it makes you realize just because COVID is a healthcare issue doesn't mean that everyone in the healthcare sector is really busy. Elective surgeries and a lot of other sorts of health industries have been sent home as well so that they're not exposed to the risk of catching COVID in the hospitals. So it's a pretty major impact that we've seen on the economies.
All right, so let's take a look at moving forward and what getting back to work could look like.
Yeah, so the think the best place to start looking is what's going on in China. As much as we might not think we can trust the data, there's some hints in how it's going to work. And so the new export orders shows that the PMIs in China have bounced back pretty strongly in Q2 because they've mostly opened their economies back up. But new export orders are not. They bounced a little bit and now they've gone back down again. And that's because there's just not the supply chain. The demand from us for their goods has gone away. And I think when we start to open up, some of the supply chains to the companies that are ready to open might not be ready to supply them. The customer demand might not be there, even if you can get your factory back to work. It's going to be a little bit more complex to open things back up than it was to shut things back down.
All right, and as we like to do, ending on a positive note.
Yeah, a couple of countries close to where I grew up are doing really well at getting rid of COVID. So as much as there is some people questioning whether the Chinese data is accurate, the fact that they've had less than 100,000 cases when the US has over 1 million cases. But when you look at the Australia on the left and the New Zealand data on the right, you can see that their measures to socially isolate people and shut the country down have pretty much got them back to 0 new cases. So it proves that it can be done. It proves that it's probably the most cost-effective way is to implement it really effectively and get back to work quicker rather than stretching things out too.
All right, Phil, great to have you with us as always. Thanks so much for joining.
No worries, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.